Nashville. Ask any investor who turned a profit in the last decade where they wish they'd deployed capital in 2021. 8 out of 10 give the same answer. No hesitation, no debate, just Nashville. It leads every real estate conversation happening across the American South right now. It has for years, not because the data still supports that conclusion, because the story stuck. That answer is 5 years old. The market that made those investors wealthy no longer exists, not at the same entry price points, not with the same return profile, not with the same cash flow math. And yet, the recommendation keeps circulating, because good stories outlive the data that made them true. 2021, the investment case for Nashville was almost embarrassingly simple. Net in-migration numbers the Sun Belt hadn't seen since Phoenix in the early 2000s. Amazon announced its operations center of excellence. Oracle relocated its headquarters. A steady stream of remote workers from San Francisco and New York arrived carrying high incomes and one shared objective: buy somewhere they could actually afford to own. East Nashville cap rates 7 to 9%. A well-positioned STR near downtown was clearing $50,000 to $70,000 in gross annual revenue. The math worked on the back of a napkin. You didn't need a spreadsheet. You didn't need a financial model. You just needed to move. The math doesn't work on the back of a napkin anymore. By early 2026, the median home price in Nashville had crossed $410,000, nearly double where it sat in early 2020. Cap rates in East Nashville, the neighborhood that defined the investment thesis for a generation of buyers, compressed to 4.2 to 4.8%. Not a minor adjustment, a structural repricing. The difference between a market where cash flow is your baseline and one where you're betting almost entirely on continued appreciation. Those are two completely different risk profiles. Treating them as the same decision is where most investors go wrong in 2026. Here's what actually happened. Nashville didn't just appreciate, it was repriced. Those are different things. Appreciation, a market grows because its underlying fundamentals are improving. More jobs, more population, more demand. Repricing, the market absorbs anticipated future growth into today's prices before that growth materializes. Nashville experienced both simultaneously between 2020 and 2024. Extraordinary returns for anyone already holding property, but the investor arriving today has already paid, in their acquisition price, for a significant portion of the growth that hasn't happened yet. The upside is partially spent before you write the check. The narrative hasn't caught up to the numbers. Real estate blogs are still publishing pieces titled, "Nashville, Top City for Real Estate Investment," citing job growth statistics and population trends that are accurate in isolation, but incomplete as an investment case. Job growth matters. Population growth matters. Neither one tells you whether the property you're buying today will generate cash flow positive returns at current entry price points and current interest rates. That calculation, the one that actually determines whether your investment works, runs on a different set of numbers than the ones being widely circulated. Nashville in 2026 is not a uniformly bad market. It's a differentiated one, and that distinction changes how you approach it entirely. Specific zones within the metro still produce viable cap rates, not at 2021 levels, but at levels that justify the risk. Suburban corridors with entry price points below $320,000 are still delivering long-term rental cash flow that the urban core can no longer match. And 3 satellite cities within 100 miles, Knoxville, Chattanooga, and Murfreesboro, are offering Nashville's growth dynamics at prices Nashville hasn't seen since 2019. The opportunity didn't vanish. It migrated. The mistake most investors make right now is applying the 2021 decision framework to a 2026 market. They hear Nashville, they remember the returns, and they assume the same inputs produce the same outputs. They won't. The inputs changed. The price-to-rent ratio changed. The regulatory environment for short-term rentals changed. The competitive environment for both STR operators and long-term landlords changed. Ignoring those shifts doesn't make you bold. It makes you late. And in real estate, being late without knowing it is expensive in ways that take years to fully surface. We're going to go through this market zone by zone, strategy by strategy, real numbers, real debt service implications, real consequences attached to every data point. By the end, you'll know exactly which version of Nashville still works in 2026, which version is a trap dressed as an opportunity, and where the more disciplined capital is actually moving right now. We'll see. Keep one number in the back of your mind as we go. 4.3%. That's the average cap rate in Nashville's most talked about investment neighborhoods today. Everything we examine from here gets measured against what that number actually means for your portfolio. Start with a number. East Nashville cap rates in 2021 averaged between 7 and 9%. Today, same streets, same building stock, same proximity to downtown. That same neighborhood trades at 4.2 to 4.8%, not a market correction. A structural repricing that cuts your NOI return nearly in half while your acquisition price doubled. If you're underwriting East Nashville in 2026 using the same return expectations from 2021, you're not analyzing the same investment. You're analyzing a memory. A cap rate is your NOI divided by your acquisition price, what the property returns before you factor in debt service. 7% on a $300,000 property, roughly $21,000 in net annual income. That same math applied to today's $410,000 median Nashville acquisition would require approximately $28,700 in NOI to hold the same return. At current compression, 4.3%, you're generating around $17,600 net on a property that costs 40% more than it did 4 years ago. That gap is where investor expectations go to die. East Nashville is the clearest compression story. But not the only one. Germantown, the neighborhood north of downtown that became the darling of the boutique renovation crowd, follows the same trajectory, only steeper. In 2021, Germantown was already semi-prime, trading at 6 to 7% for well-positioned properties. By 2026, those cap rates had compressed to 3.8 to 4.2%. Entry price points for a duplex or small multifamily, north of $550,000 in most cases. The investors who moved early and did the renovation work made exceptional returns. The investors arriving now are buying their exit. North Nashville tells a more complex story, and a more interesting one. Historically underinvested and slower to appreciate than East Nashville or Germantown, it entered the current cycle at lower entry price points with more room to run before compression set in. Cap rates there today sit at 5 to 5.8%, meaningfully stronger than the prime neighborhoods. In certain pockets along the Buchanan Street corridor and near the Jefferson Street Arts District, properties are still trading below $350,000 with viable, long-term rental income. Not the straightforward play that East Nashville was in 2021, but one of the few zones within Nashville city limits where the cash flow investing math hasn't completely broken down. The suburban ring is where the most investable Nashville numbers actually live in 2026. Antioch, Hermitage, Madison, and parts of La Vergne are producing cap rates in the 5.5 to 6.5% range. Not because these areas dramatically improved, but because their entry price points haven't caught up to the urban core in the same way. Properties below $320,000, paired with a long-term rental strategy targeting working families rather than short-term guests, are generating cash flow positive outcomes in a market where that result is increasingly hard to find. The trade-off is obvious. You're not buying in East Nashville. The appreciation story is less compelling, but you're buying an investment that actually functions as one, not a speculative bet dressed in rental income clothing. Here's the metric that puts all of this in context. The price-to-rent ratio in Nashville's prime neighborhoods, the relationship between what a property costs and what it generates in annual gross rent, currently sits at 22 to 25 times annual rent. A functional investment market runs at 15 to 18 times. Anything above 20 signals the market is pricing in future appreciation rather than current income. At 22 to 25, the numbers only work if the property keeps appreciating. That's a bet, not an investment thesis. The suburban corridors, by contrast, are running price-to-rent ratios closer to 17 to 19 times, still elevated by historical standards, but inside the range where cash flow positive outcomes don't require heroic rent growth assumptions to work. One more number: Nashville's metro-wide rental vacancy rate, 7.1%. In 2021 and 2022, vacancies were running below 4%. Landlords held all the leverage, and every unit filled fast. That's no longer the market. But the 7.1 figure is a metro average, and averages hide the story. Urban core zip codes adjacent to downtown are running closer to 9% vacancy, a direct consequence of the condo and apartment construction boom that ran through 2022 and 2023. The suburban ring is tighter, below 6% in several corridors. That divergence is the market communicating, in the language of actual occupancy data, exactly where the real demand sits, and it points toward the same conclusion the cap rate analysis already produced. In 2026, the investable Nashville is in the suburbs. Between 2019 and 2022, Nashville's STR market made investors look like geniuses. A well-located two-bedroom near East Nashville or Germantown was clearing $60,000 to $80,000 in gross annual revenue through Airbnb and VRBO. Occupancy above 75% on well-managed properties. Average daily rates in premium zip codes, $230 to $260 a night. The investors who read that window early moved fast, locked in their non-owner-occupied permits before the regulatory environment shifted, made exceptional returns. The problem: everyone saw those returns. Then, everyone tried to replicate them simultaneously. By 2023, Nashville had accumulated one of the highest concentrations of STR inventory per capita in the entire South. Neighborhood associations filed complaints. Housing advocates argued that STR conversion was pulling long-term rental supply out of a market already under affordability pressure. The city's response was predictable and, from a policy standpoint, defensible. Nashville tightened owner occupancy requirements, restricted non-owner-occupied STR permits in residential zones, and stepped up enforcement of existing rules. By 2026, roughly 60% of the Nashville metro operates under active short-term rental restrictions, either prohibiting non-owner-occupied rentals outright or capping the number of permits issued per district. That 60% figure needs to be read carefully. It doesn't mean 40% of the market is freely open. It means 40% of the metro hasn't yet implemented the most restrictive tier. But many of those areas carry their own permit caps, application backlogs, and compliance requirements that make new STR entry slow, expensive, and uncertain. Buying a Nashville property, listing it on Airbnb within 30 days, generating income from month one, that model is functionally over for most of the metro. What replaced it? A permit-dependent, zone-specific operating environment, where the licensing process alone runs 3 to 6 months. Operating without a valid permit exposes owners to fines that directly erode the income they were counting on. The supply side makes it worse. Inventory that got grandfathered under previous regulations, properties that secured non-owner-occupied permits before the gates closed, is still operating and still competing for the same pool of guests. Nashville's STR supply didn't contract when regulation tightened. It stopped growing while demand continued normalizing post-pandemic. The result: average occupancy rates across the metro have fallen from their 2021 and 2022 peaks. Markets that ran at 75 to 80% are now averaging 58 to 62% across the broader metro. Average daily rates held better in premium locations, but in the mid-market segment, the two-bedroom renovated bungalows that define the Nashville STR playbook, rate growth has stalled. In some corridors, it reversed. Here's what underwriting a Nashville STR actually looks like in 2026. A two-bedroom in East Nashville, one of the few remaining zones where non-owner occupied permits are still theoretically available, pending application approval, trades at roughly $420,000 to $460,000 for a property with genuine STR appeal. At 60% occupancy and an average daily rate of $210, approximately $46,000 in gross annual revenue. After platform fees, property management, cleaning, utilities, insurance, maintenance, and permit costs, your NOI lands between $22,000 and $26,000. On a $440,000 acquisition, that's a cap rate of 5 to 5.9% before debt service. With a 30-year mortgage at current rates, most of these deals are cash flow neutral at best. You're not generating income on the rental, you're betting on appreciation to justify the operating overhead. STR still produces viable returns in Nashville, but only in specific, shrinking pockets, properties in the immediate downtown core and the Broadway entertainment corridor, where tourist demand is concentrated and least sensitive to platform saturation, are still posting stronger average daily rates and higher occupancy than the broader metro. Owner-occupied STRs, where the owner lives on site and rents part of the property, remain legal across most of the metro and represent the most accessible entry point for investors who want STR exposure without the full permit complexity. A narrow category of specialized properties, large group accommodations for bachelorette weekends and corporate retreats, driven by Nashville's year-round tourism, continue to outperform metro averages by a significant margin. But none of these are the scalable, repeatable plays the STR narrative implies. They are exceptions. They require specific assets, specific locations, and operating expertise that most investors entering the market don't come in with. The Nashville STR picture in 2026 comes down to one structural problem. The strategy that worked from 2019 to 2022 required two conditions to exist at the same time: low entry price points and permissive regulation. You can still find permissive regulation in a few narrow zones, but not at low entry prices. You can find lower prices in the suburban ring, but not with STR favorable regulation. The window where both aligned is closed. Investors still recommending Nashville as an STR market in 2026 are either selling you a permit they already hold, or they stopped updating their analysis 2 years ago. Marcus had been running the Nashville STR playbook since 2020. 2 properties in East Nashville, both permitted before the regulatory crackdown, both generating strong returns through 2022. Then, the occupancy numbers started drifting. Permit renewals got more complicated. A third property he'd been planning to acquire, a renovated bungalow near 5 Points, came in at $430,000. When he ran the STR income against that acquisition price, the numbers didn't clear his minimum return threshold. So Marcus did what most investors in his position resist, because it feels like a step back. He pivoted to long-term rental in the suburbs. Within 14 months, the cash flow on his new Antioch duplex was outperforming what his East Nashville STR properties were generating net, at an entry price point 40% lower. Marcus's story isn't a case study, it's the arithmetic of a market in transition, and the math points in the same direction every time. Long-term rental in Nashville's suburban corridors is producing the most reliable cash flow numbers in the entire metro right now. Not because anything exceptional is happening in Antioch or Hermitage or Madison, because the fundamentals that define a workable LTR investment are still intact there in ways they no longer are in the urban core. Entry price points below $320,000, rent-to-price ratios that hold up under current financing rates. A tenant base of working families with stable employment, people who stay longer and turn over far less frequently than the STR guest cycle ever allowed. Less glamorous, more reliable. Here are the actual numbers. A 2-bedroom, one-bath, single-family home in the Antioch corridor, roughly 15 miles southeast of downtown, currently trades between $270,000 and $310,000 for move-in-ready condition. Monthly market rents for comparable units in that submarket, $1,550 to $1,750. At a $300,000 acquisition with 20% down, your principal and interest at current rates lands around $1,490 per month. Add property taxes, insurance, and a maintenance reserve. Total monthly expenses sit at approximately $1,850 to $1,950. At market rent, you're at break-even or modestly cash flow positive. In the context of Nashville's broader market, that outcome is one the prime neighborhoods haven't been able to deliver for 2 years. The Hermitage corridor produces cleaner numbers than Antioch, and the reason is specific. Rental demand there is driven by proximity to distribution, healthcare, and light manufacturing employment along the east side of the metro. That demand runs consistently above the broader suburban average. Properties in the $260,000 to $290,000 range are generating rents of $1,500 to $1,650 monthly. Submarket vacancy, below 5.5% in the strongest pockets. Lower acquisition price, stable tenant demand, below average vacancy. Net cap rates in the 5.8 to 6.4% range. Not a 2021 number, but a number that builds a portfolio over a 5 to 7 year hold horizon. Nashville's metro-wide rental vacancy sits at 7.1%, elevated against pandemic-era lows, but inside the range of a functional rental market. What that average conceals is the sub-market divergence. Downtown-adjacent zip codes in the urban core are running 8.5 to 9% vacancy, a direct consequence of the condo and apartment construction boom of 2022 and 2023. The suburban ring is tighter, 4.8 to 6% in the strongest corridors. Lower vacancy means your income assumptions are more reliable. Your underwriting is more conservative by definition. Your actual annual return is less exposed to the cost of a vacant unit between tenants. The data is pointing in one direction. It has been for a while. Madison sits directly north of downtown, across the Cumberland River, and it deserves specific attention because its entry price points are still accessible in ways most of the east and southeast suburbs are not. Median acquisition prices for small multifamily and single-family investment properties in Madison, $250,000 to $285,000. The neighborhood has been in a slow, sustained gentrification arc for nearly a decade, driven by proximity to downtown and the gradual northward expansion of Nashville's restaurant and retail corridors. Rents are lagging the appreciation slightly. In most markets, a warning sign. In Madison, it reflects a tenant base that's transitioning, not collapsing. For an investor willing to hold a 5 to 7 year horizon, Madison's current rent-to-price ratio, combined with its trajectory, is one of the stronger risk-adjusted positions in the entire Nashville metro. The pattern across all of these suburban positions is the same. Long-term rental in Nashville in 2026 is a strategy of precision, not broad market exposure. Buying anywhere in the suburbs and assuming the fundamentals hold is exactly as flawed as buying anywhere in East Nashville and assuming they don't. The difference between a cash flow positive investment and a speculative holding is often 10 to 15 miles, $20,000 in acquisition price, and the discipline to run the actual numbers instead of the narrative. If the capital can't find adequate returns in the market everyone is talking about, where did the opportunity actually go? In Tennessee's case, it didn't leave the state. It moved down the interstate. Knoxville, Chattanooga, and Murfreesboro share Nashville's core demand drivers: population growth, university presence, healthcare employment, proximity to major logistics corridors. At entry price points Nashville hasn't offered investors since 2019. These are not consolation prizes For a disciplined investor running real underwriting numbers, they are currently the better trade. Knoxville is the most direct comparison. Median home price, $285,000 against Nashville's $410,000. A 44% price differential between two cities in the same state. Same regional labor market dynamics, similar population growth trajectories, comparable job bases anchored by the University of Tennessee, the Oak Ridge National Laboratory Employment Corridor, and a healthcare sector built around the University of Tennessee Medical Center. Cap rates on investment properties in Knoxville are currently running between 6 and 7.5% in well-positioned neighborhoods. Those are the numbers Nashville's prime zones were posting in 2021. An investor deploying capital into Knoxville today is buying into a market roughly 3 to 4 years behind Nashville on the appreciation curve, with the same fundamental demand drivers pushing it forward. Chattanooga's investment case runs on a different foundation, and an equally strong one. The city has gone through one of the most dramatic economic shifts of any mid-size American city in the last 15 years. A broadband infrastructure build-out made it a destination for remote workers and technology. For to power the adjacent businesses a full decade before the remote work migration of 2020 became a national story. Volkswagen's manufacturing plant, Amazon's regional fulfillment infrastructure, and a growing creative economy have diversified the job base well beyond what most investors expect from a Tennessee secondary market. Median acquisition prices for investment-grade properties in Chattanooga currently sit between $260,000 and $320,000. Cap rates 5.5 to 7%, depending on submarket and property type. The North Shore and East Brainerd corridors are producing LTR numbers that outperform anything comparable Nashville has offered for at least 2 years. Murfreesboro occupies a specific position in this comparison. It is simultaneously a standalone market with its own fundamentals and a direct Nashville satellite, where Chostin close enough to capture Nashville employment overflow, far enough that its entry price points haven't been pulled fully into the Nashville premium. 35 miles southeast of downtown along Interstate 24. Home to Middle Tennessee State University, enrollment over 22,000 students, a built-in rental demand floor that insulates the market against broader vacancy swings. Median investment property prices, $280,000 to $330,000. Cap rates holding between 5.8 and 6.8%. Rental vacancy in the strongest corridors, tracking below 5%. For an investor who wants Nashville-adjacent exposure without Nashville-level acquisition costs, Murfreesboro is the most direct expression of that thesis available right now. Here's the comparison that cuts to the center of this analysis. An investor with $300,000 entering Nashville today is buying in the suburban ring at the edge of viable cash flow, competing with established landlords for a shrinking inventory of sub-$320,000 properties with limited appreciation upside in a market that has already run hard. That same $300,000 entering Knoxville today acquires a property generating 6 to 7% cap rate returns in a market where the repricing cycle is earlier in its arc and the appreciation runway is cleaner. The risk-adjusted return on that Knoxville position over a 5 to 7 year hold horizon is not marginally better than Nashville. It is structurally better. The data makes that case without requiring optimistic assumptions about either market. The counter-argument to the satellite market thesis deserves a direct response because it contains a real risk. These markets are smaller, less liquid, and more exposed to single employer or single institution shocks than a market the size of Nashville. If the University of Tennessee contracts significantly, Knoxville's rental demand profile changes in a meaningful way. If Volkswagen reduces operations in Chattanooga, that market absorbs a real hit. Nashville's demand base, spread across healthcare, technology, entertainment, and corporate headquarters activity, provides a floor that smaller markets can't fully match. Choosing Knoxville or Chattanooga over Nashville means accepting concentration risk in exchange for better entry price points and higher current yield. That trade is worth making for most investors. But it is a trade, not a free position, and sizing it correctly within a broader portfolio is part of running the analysis right. What the satellite market comparison ultimately shows is this: the Tennessee real estate opportunity in 2026 is not a question of whether to invest in the state. It's a question of where within the state the math is currently most favorable. Nashville built the narrative that put Tennessee on every investor's radar. Knoxville, Chattanooga, and Murfreesboro are where the numbers that originally made Nashville compelling have quietly gone. The investors who follow the data rather than the story are the ones who find them, zone by zone, strategy by strategy, market by market. The cap rate compression in East Nashville and Germantown, the STR regulatory wall that shut the short-term rental arbitrage window across 60% of the metro. The suburban LTR corridors where cash flow still exists if you're disciplined about entry price points, and the satellite markets, Knoxville, Chattanooga, Murfreesboro, where Nashville's original investment thesis, relocated with better numbers attached. All of it points in the same direction. Here is what the data actually says to do in Nashville in 2026. No hedging. If you are a remote worker or high-income professional relocating from a coastal market, Nashville as a place to live still makes financial sense, with one condition: separate the relocation decision from the investment decision. They are not the same calculation in this market. Moving to Nashville from San Francisco, New York, or Chicago on a remote income of $90,000 or above is a rational move. The cost of living differential, the absence of state income tax, and the quality of life relative to price are all still favorable. But buying in East Nashville or Germantown as both your primary residence and your investment vehicle, assuming the appreciation runway of the last 5 years continues at the same rate, is where the logic breaks. Buy to live in Nashville if that is where you want to be. Underwrite the purchase as a home, not as a guaranteed wealth-building instrument. That's the correctly calibrated version of this decision. If your primary objective is cash flow, the verdict is direct. Nashville City proper is not your market in 2026. The math does not support a cash flow investment thesis in East Nashville, Germantown, or the near North Nashville corridors at current entry price points. The numbers that define Nashville's investment opportunity have moved. Chasing them inside the city, limits at $410,000 median prices and 4.3% cap rates, is a bet on continued appreciation, not a cash flow investment. That bet may pay off. Appreciation in a growing Sunbelt metro is not an irrational thesis. But be clear about what you are actually buying. A speculative position on future price growth, size that position accordingly. If you are an investor with a cash flow mandate and a Tennessee focus, your capital belongs in one of 3 places right now. First, the Nashville suburban ring, Antioch, Hermitage, and the strongest pockets of Madison, where entry price points below $320,000 and submarket vacancy below 6% are still producing viable LTR returns in the 5.5 to 6.4% net cap rate range. Second, Knoxville, $285,000 median acquisition price, 6 to 7.5% cap rate environment. Demand base anchored by the University of Tennessee and the Oak Ridge Employment Corridor. The clearest value proposition in the state right now. Third, Murfreesboro, for investors who want Nashville's satellite exposure with a built-in rental demand floor from Middle Tennessee State University and an entry price point that hasn't yet fully absorbed the Nashville overflow premium. Chattanooga belongs in a separate category, not because the fundamentals are weaker, but because the investment thesis requires a different operator profile. The strongest returns there are concentrated in specific corridors where the gentrification arc is active but not yet complete. Capturing those returns requires either local market knowledge or a property management relationship with genuine sub-market expertise. For the investor who can access that. Chattanooga at current prices is a strong, risk-adjusted position. For the investor underwriting remotely without local intelligence, The Knoxville or Murfreesboro thesis is more straightforward to execute cleanly. If you are currently holding Nashville investment property, permitted STR assets, in the urban core in particular, the picture is specific but not ambiguous. Properties generating cash flow positive returns under current regulation and current occupancy levels are worth holding, provided your acquisition basis is low enough that your effective cap rate on cost remains healthy. Nashville has not collapsed and is not going to collapse. The underlying demand drivers are real. The job base is diversified. The population trajectory remains positive. But if you are holding a cash flow neutral or negative Nashville STR with a high acquisition basis, counting on continued appreciation to cover the operating gap, the analysis points in one direction. Or rotating that capital into the satellite markets produces a better risk-adjusted outcome over the next 5 years than holding and waiting. The conclusion that runs through all of it is the same one that opened this analysis. Nashville in 2026 is not Nashville in 2021. Investors who treat it as though it still is will underperform. The city is real. The growth is real. The opportunity is real. It is just more specific, more differentiated, and more demanding of precision than the version that existed when the returns were obvious and the competition was thin. The data has been pointing in a clear direction this entire time. The only question is whether you follow it or keep following a story the numbers stopped telling 2 years ago.